Hello everyone, and welcome to this FinQuiz video lecture on market organization and structure. Today we're going to cover the key concepts you need to understand about how financial markets are set up and operate. Market organization and structure, so guys, that's the core of everything in finance. Sounds a bit technical, right? Don't worry, we're going to break it down in a way that actually makes sense. It is like the backbone of our economy. This is all about how financial markets work, what gets traded, who the key players are, and why it all matters for you as a future CFA charter holder. Now, you might be wondering why this is important. Well, the financial system is like the backbone of our economy. It helps us save, borrow, invest, and manage risks. Without a well-structured financial system, things would be absolute chaos. Think of a marketplace with no rules, no order, and no way to tell if you're getting a fair deal. That's why we have structured markets, different types of assets, and financial intermediaries that help connect buyers and sellers. Imagine you're planning a trip around the world. You need to save money, maybe borrow a bit, and manage the risks of currency fluctuations. The financial system is what makes all of this possible. It includes markets and intermediaries that facilitate the transfer of assets and risks from one person or entity to another across different places and times. Before we jump deeper, quick heads up, that PDF you see on your screen, you can grab a copy to support your CFA journey. It's packed with insights that'll help you master these concepts. And don't forget, FinQuiz offers Stanley Notes for an in-depth review, formula sheets, so you've got all formulas in one place, mock exams to make sure you're exam ready. And hey, if you're serious about passing, check out the FinQuiz question bank too. It's packed with high-quality practice questions that'll sharpen your skills and get you exam ready. Let's go. All right, let's get into the details. Ready? Let's talk about the different ways we use the financial system. First up is saving. Think about setting aside money for future needs, like retirement, buying a house, or even that world trip. Individuals save to meet future expenses, and companies do the same to pay suppliers, repay debt, or invest in new projects. To save, people might buy certificates of deposit, bonds, stocks, mutual funds, or real estate. When you save to earn a financial return, you're considered an investor. And as investors, we expect a return that compensates us for the risk of loss and inflation eroding our money's value. On the flip side, sometimes we need money now for immediate needs. Maybe you're taking out a student loan for college or a mortgage for a new home. Companies might borrow to fund operations or expand. Even governments borrow to fund projects and provide services. Borrowing can come from mortgages, personal loans, issuing bonds, and so on. To make borrowing more accessible and cheaper, borrowers might pledge assets as collateral. This is like when you use your house as security for a mortgage. Credit bureaus and rating agencies also play a crucial role by providing information that helps lenders assess the risk of lending to you. And let's not forget, governments establish laws and courts to protect both borrowers and lenders, making the whole system more trustworthy. Now, borrowing isn't the only way to raise funds. Companies can also raise money by selling ownership stakes. This is equity financing. You've probably heard of companies issuing stocks. They often use investment banks to help with this process. And when markets are liquid, meaning assets can be easily bought or sold, it's much easier for companies to raise equity capital because investors feel more confident they'll be able to trade their shares when they want. Life is full of uncertainties, and the financial system helps us manage various risks. Think about a farmer worried about crop prices falling or an airline concerned about fuel prices rising. They can use financial instruments like forwards, futures, options, and swaps to hedge against these risks. For example, An airline might lock in fuel prices for the next year to avoid the risk of price spikes. These instruments are most effective when they're traded in liquid markets, where it's easy to enter and exit positions. Now that we've got a solid foundation on how financial markets are structured, let's get into what the financial system actually does and why it's so important. Think of it as the engine that keeps the economy running. Without it, businesses wouldn't get funding, investors wouldn't have opportunities, and savers wouldn't be able to grow their wealth. The financial system also lets us exchange assets both now and in the future. If you've ever traveled abroad and exchanged currency, you've participated in this function. Companies that operate internationally need to exchange currencies regularly. A US company paying a supplier in euros will need to convert dollars to euros, possibly using spot markets for immediate exchange or forward contracts for future transactions. At its core, the financial system allows people to trade assets, whether for immediate delivery, spot markets, or future transactions, derivatives, contracts, and loans. Imagine a multinational corporation that earns revenue in multiple currencies but pays its employees in a single currency. If they get paid in euros, yen, and pounds but need dollars to make payroll, they have to convert that foreign currency into domestic currency through the Forex market. That's an example of immediate delivery in action. Now, let's say that same company fears that the currency will depreciate before they can convert it. What do? They hedge their risk by investing in gold or a stable asset that moves in the opposite direction of their currency exposure. This is where the financial system plays a huge role in managing risks. Markets aren't just about moving money around, they're about trading on information. Think about two types of traders: pure investors. They're in the game to move wealth from today into the future. Maybe they're planning for retirement, a big purchase, or just want to let their money grow over time. Information-motivated traders. These are the people trying to profit from having better information than the rest of the market. Hedge funds, analysts, and active fund managers spend billions every year to get a slight edge, buying when prices are low and selling when they rise. Let's take an example. Imagine an investor hears a rumor that a tech company is about to release a revolutionary AI chip. If they act fast, they might scoop up shares before the news goes public and prices soar. But remember, not all information-motivated trades work out. Sometimes the market already priced in that information, or worse, the information was flat out wrong. This is why markets that have high liquidity and low transaction costs make information-driven trading more efficient. If you're stuck with a high-cost, illiquid investment, even the best info won't help you turn a profit. Now, let's talk about one of the biggest factors in investing: returns. Your expected rate of return comes from two big forces. The supply of funds. This comes from people saving money. When people save more, banks and lenders have more money to lend. The demand for funds. This comes from businesses and individuals looking to borrow. If returns on investments are too high, people stop spending today and save more for the future. That leads to an oversupply of money in the financial system, which pushes interest rates down. On the flip side, if returns are too low, businesses and borrowers rush in to raise funds, increasing the demand for money. That pushes interest rates up. That's how we get the equilibrium interest rate, the rate where the amount saved equals the amount borrowed. It's the sweet spot where money flows efficiently through the system. And let's not forget, not all investments have the same required rate of return. Stocks generally require a higher return than bonds because they're riskier. Long-term bonds require a higher return than short-term bonds because investors lock up their money for a longer time. Illiquid investments require higher returns to compensate for the difficulty of selling them quickly. So at the heart of understanding rates of return is this balance between supply and demand for money. Imagine the whole economy is like a huge savings and borrowing marketplace. The people with extra money, like savers, supply funds, while those who need money, called borrowers, create demand for it. This is basically what people expect to earn from investing or lending money. And like in any marketplace, how much people are willing to save or borrow is influenced by the expected rate of return. Here's how it works. If the rate of return is too high, people think, wow, I'll get a good deal on my savings. So they're likely to save more instead of spending now. When lots of people are saving, there's plenty of cash in the system, meaning supply of funds greater than demand for funds. If the rate of return is too low, it's the opposite. People or companies looking to raise money by selling equity, like stocks, or taking out loans go, not worth it at that low rate. So supply of funds is lower than demand for funds, and there might be a borrowing squeeze. Think of the interest rate as the rent on money. It's what you pay to borrow cash or what you earn when you lend it out. Just like renting an apartment, the demand for money changes depending on what people want to spend or save for. High demand for money now, called current consumption. People want to spend now, whether it's on shopping, new businesses, etc., and this pushes interest rates higher. On the other hand, high demand for money later, meaning future consumption. Here, people are saving up for future use, so the current demand for money goes down, and that can lower interest rates. And as I said earlier, equilibrium interest rate is the just right interest rate, where the amount people want to save is exactly equal to the amount others want to borrow. It's like when you go to a farmer's market and find the perfect price where sellers are happy to sell and buyers are happy to buy. And this equilibrium rate holds under ideal conditions where all investments are equally risky with equal terms and liquidity, how easily you can convert them to cash. Now, how does all this fit into making sure money flows to the best places? This is where capital allocation efficiency comes in. When an economy is efficient, it means funds are going to the places where they can be used most productively. For example, say you have $10,000 to invest. In a market-based system, you could invest directly by buying stocks or bonds you choose. A well-functioning financial system isn't just about moving money around, it's about making sure capital flows to the most productive opportunities. Think of it like this. If investors have bad information, they could fund projects that are actually a waste of money. Imagine a company that's hyped up but has no real profits. If investors believe the hype and overestimate its value, they might throw money at it and lose in the long run. On the other hand, if investors underestimate the potential of a company, they might miss out on a huge opportunity. Think of early investors who ignored companies like Amazon or Tesla because they didn't fully grasp their long-term potential. This is why financial markets exist, to provide accurate, timely information so that capital flows to the best investments. Why a strong financial system matters. A well-functioning financial system benefits everyone. It keeps transaction costs low so people can save and borrow efficiently. It helps analysts and investors properly value assets and businesses. It makes sure that scarce capital goes to the best possible uses. And at the end of the day, that's why understanding financial markets is so important for anyone pursuing the CFA charter. Whether you're analyzing stocks, trading bonds, managing risk, or allocating capital, you need to know how the system works. Now that we've covered the functions of the financial system, let's shift gears and talk about the types of assets and contracts that circulate within it. In the financial world, we deal with two main types of assets: financial assets and physical assets. Financial assets include things like securities, currencies, and contracts. These are intangible and represent a claim to future cash flows or ownership rights. Physical assets, on the other hand, are tangible items like commodities and real estate. Securities can be either public or private. Public securities are traded in public markets like the New York Stock Exchange or NASDAQ. They're accessible to anyone and tend to be more liquid because they're easier to buy and sell. Private securities aren't traded on public markets and are typically available only to qualified investors. Venture capital investments in startups are a good example. Markets themselves can be classified in various ways. We have spot markets, where assets are traded for immediate delivery, and forward markets, where contracts are made today for delivery in the future. Options markets deal with contracts that give the right, but not the obligation, to buy or sell in the future. Then there are primary markets, where new securities are issued, and secondary markets, where existing securities are traded among investors. Money markets deal with short-term debt instruments like treasury bills, while capital markets handle longer-term instruments like bonds and equities. All right, let's talk about traditional versus alternative investments, because understanding the difference is key for anyone looking to navigate financial markets. Traditional investments are what most people think of when they hear investing. We're talking stocks and bonds that trade on public markets, plus mutual funds and ETFs that hold those assets. They're straightforward, liquid, and easy to value because there's always a market price flashing on your screen. Now enter alternative investments. This is where things get interesting. Think hedge funds, private equity, real estate, commodities, securitized debt, even operating leases and collectibles. Yes, even a rare vintage Ferrari or a Picasso can be considered an alternative investment. Unlike stocks and bonds, these assets are harder to buy and sell quickly, and because there's no public market setting their prices daily, valuing them can be tricky. That's why they often trade at a discount to their intrinsic value. Investors demand a bargain in exchange for tying up their money in something that might take years to sell. Take private equity, for example. When venture capital firms invest in a startup, there's no stock ticker showing the company's value. It's all about projections, industry trends, and gut instinct. The same goes for real estate. A shopping mall in New York doesn't have a market price that changes every second like Apple stock does. That's what makes alternative investments a different ballgame. They offer unique opportunities but require patience and a different risk mindset. All right, let's talk about securities now. If you've ever watched financial news, you've probably heard words like stocks, bonds, commercial paper, or repos being thrown around. But what exactly are these? Let's get into it. Securities are the most actively traded assets alongside currencies, contracts, commodities, and real assets. They come in two main flavors, fixed income and equities, and both serve different purposes for investors and companies. Now, fixed income, consider these as the I'll pay you back assets. When a company, a bank, or a government needs cash, they don't always sell stock. Sometimes they borrow money from investors by issuing fixed income securities, basically IOUs with interest. These include bonds and notes, bills, commercial paper, and certificates of deposit, convertible bonds, repurchase agreements, you name it. Fixed income instruments are essentially loans made by investors to borrowers. When you buy a bond, you're lending money to the issuer in exchange for regular interest payments and the return of principal at maturity. These can be government bonds, corporate bonds, or even certificates of deposit from banks. There's a difference between notes and bonds based on maturity. Notes are shorter term, while bonds are longer term. Think of it like lending money to a friend. If they promise to pay you back in 5 years, that's a bond. If it's a short-term loan, that's a note. Then we have convertible bonds, which can be converted into a predetermined number of the issuer's equity shares. This gives investors the potential upside of owning stock while still receiving regular interest payments. Think of convertible bonds like the best of both worlds. These start off as bonds, but if the company's stock price shoots up, you can convert them into shares and ride the growth wave. If the stock tanks, you still get paid like a bondholder, win-win. Then there are other instruments like bills, commercial paper, and certificates of deposit. These are short-term debt issued by governments, corporations, or banks to raise cash quickly. These mature in less than a year. Repos, repurchase agreements. Think of these like pawn shop loans in finance. Banks sell securities with a promise to buy them back later at a slightly higher price, a quick way to raise short-term cash. If fixed income is lending money, equities are owning part of the company. When you buy shares, you become a part owner, meaning you get voting rights, dividends, and a claim on company assets. First off, common shares. These are your everyday stocks. They come with voting rights and dividends. If the company does well, you benefit from price appreciation. But if a company goes bankrupt, common shareholders are last in line to get paid. Preferred shares are a mix between stocks and bonds. Preferred shareholders get paid dividends first before common shareholders and in a liquidation. So they have higher claims to assets. However, they don't always have voting rights. So remember, preferred shares usually don't come with voting rights, but offer fixed dividends and have priority over common shares when it comes to dividend payments and asset liquidation. Warrants give you the right to buy a company's stock at a specific price before a certain date. Companies might issue warrants to make their bonds or preferred stock more attractive. Think of warrants like a golden ticket to buy shares at a fixed price in the future. If the stock price skyrockets, you buy at a discount and cash in big. So why does all of this matter? Because understanding securities is key to making smart investment decisions. Whether you're looking for steady income with bonds, growth potential with stocks, or a mix of both. And for your CFA exam, you'll need to know the fine print on each of these. All right, let's talk about pooled investments, because not everyone wants to pick individual stocks or bonds. Sometimes it's easier and smarter to invest in a diversified basket of assets through a pooled investment vehicle. Think of it like joining a club where everyone chips in money and a professional manager handles the investments. It might sound a bit technical at first, but once we break it down, it's really just about grouping resources together to get better investment opportunities. The general idea here is that instead of buying individual stocks or bonds yourself, you buy shares in an investment vehicle that's already holding a bunch of different assets. Let's take a look at the types of pooled investments, starting with the basics. So, what exactly are pooled investment in financial world? In simple terms, pooled investment vehicles allow individual investors to buy into a pool of assets that's managed by professionals. These vehicles come in different shapes and sizes, but they all share one common goal: to give investors access to a broader set of investments, often at a lower cost than buying individual securities on their own. Think of it like joining a team. Instead of trying to be the best player yourself, you join others to increase your chances of success. Let's break down a few types of pooled investments. You'll encounter these a lot in your career, so get comfortable with the terminology. A mutual fund is like a big basket that holds shares of various companies, When you invest in a mutual fund, you're buying a share of that basket. So for example, if you invest in a mutual fund that focuses on technology stocks, your money is pooled together with other investors' funds to buy shares in a collection of tech companies. The securities issued by mutual funds are called shares. The fund itself buys and holds stocks, bonds, or other assets, and you, as an investor, own a share of that fund. Trusts are another form of pooled investment, but instead of shares, what you own are called units. A trust is usually set up to hold a collection of assets, like real estate, bonds, or stocks, for a specific purpose. Investors buy units of the trust, and those units represent their ownership stake in the assets held by the trust. Here, instead of shares, we call them units. They give you ownership in whatever assets the trust holds. Now, we're getting into the world of exchange-traded funds, ETFs, and exchange-traded notes, ETNs. These are a bit more complex, but also quite popular, especially among more active traders. ETFs and ETNs are like mutual funds, but they're traded on stock exchanges, just like individual stocks. So let's get into, in some details, exchange-traded funds. Imagine a fund that holds a basket of stocks, like an index fund. But unlike a traditional mutual fund that only lets you buy or sell once a day at the net asset value, an ETF can be bought or sold throughout the day on the stock exchange. What's cool about ETFs is they generally trade very close to their net asset value, thanks to a mechanism involving authorized participants, APs. If the price of an ETF is lower than its net asset value, authorized participants can step in and buy shares from the market at the lower price, then redeem them with the ETF for the higher net asset value. On the flip side, if the ETF price is higher than its net asset value, APs will buy shares from the ETF at net asset value and sell them at the higher market price. This keeps the price of the ETF closely aligned with the value of the assets it holds. Now, with ETFs, there is an interesting concept of in-kind transactions. With ETFs, deposits and redemptions are usually done in kind, meaning you don't pay cash to buy shares of the ETF. Instead, you deliver a basket of securities, like a portfolio of stocks or bonds, and in return, you get shares of the ETF. Similarly, when you sell your ETF shares, you might get a basket of securities instead of cash. So you might be wondering, what exactly are ETNs? ETNs, exchange-traded notes. ETNs are like ETFs, but they don't hold any assets. Instead, they're a debt instrument issued by a bank or financial institution that promises to pay returns based on the performance of a specific index. You can trade them on the exchange, just like an ETF, but keep in mind that they are subject to the credit risk of the issuer. Hedge funds are a whole different beast. They don't just let anyone in. You have to be a qualified investor, meaning you're wealthy, experienced, and know what you're doing. So guys, unlike mutual funds or ETFs, hedge funds are generally reserved for qualified investors, meaning those who meet certain financial criteria, like being wealthy or having a deep understanding of the markets. Here's the structure. The hedge fund managers are called general partners. They run the show and make investment decisions. Investors are called limited partners. They provide the capital but don't have a say in day-to-day operations. Unlike mutual funds or ETFs, hedge funds can invest in anything: stocks, bonds, real estate, derivatives, private equity, even art and collectibles. They use complex strategies like short selling, leverage, and derivatives to generate returns. The securities issued by hedge funds are called limited partnership interests, and these investors typically have to meet certain income or asset thresholds to invest in them. So why do investors go for pooled investments in the first place? Let's explore some key reasons. One of the biggest advantages of pooled investment vehicles is diversification. By pooling money together, investors can access a much wider range of securities than they could on their own. This lowers the risk because you're not relying on just one stock or bond to perform well. Managing individual investments can be expensive, especially when it comes to buying small amounts of various assets. Pooled vehicles help reduce these costs since the fund manager is managing a large pool of assets at once, making it cheaper per investor. Many investors choose pooled investments because they don't have the time or expertise to manage individual investments themselves. These vehicles are typically run by professional fund managers who have the experience to pick securities that align with the fund's strategy. For most investors, pooled investment vehicles are a great way to diversify without spending a fortune. Instead of buying 50 different stocks yourself, you can just buy one ETF or mutual fund that gives you exposure to all of them. Lower costs, lower effort, and built-in diversification. One last thing, when we talk about securities, we're really talking about issues. Securities that have been sold to the public or can be resold. The most common issuers? Companies and governments. They're the ones creating the investment opportunities that power the financial markets. And that's the beauty of pooled investments. They allow small investors to tap into markets they couldn't access otherwise. Whether it's stocks, bonds, or alternatives, there's a pooled investment vehicle for everyone. All right, let's talk about the real, tangible things that drive the economy: currencies, commodities, and real assets. We're moving beyond just stocks and bonds here. This is about the money we use, the raw materials that build the world, and the physical assets that power industries. Think of currencies as the oxygen of the global economy. Every country has its own, but only a few hold real power in global markets. These are called reserve currencies. The US dollar and euro are the big players. Almost every central bank holds them in large quantities because they're stable, widely accepted, and used in international trade. The British pound, Japanese yen, and Swiss franc are also used as backup reserve currencies, but not as much as the big two. Now, how do you actually trade currencies? Well, if you've ever exchanged money at an airport kiosk before an international trip, you've done a retail currency trade. But for businesses, currency trading is a whole different ballgame. Let's say Apple is manufacturing iPhones in China, but selling them worldwide. They earn revenue in US dollars, but they have to pay their suppliers in Chinese yuan. So they're constantly trading currencies to balance their finances. And if the yuan suddenly strengthens against the dollar, Apple's costs go up, squeezing their profit margins. That's why companies hedge currency risks using financial instruments like forwards and options. When we talk about commodities, we're talking about the raw materials that fuel industries and everyday life. There are four major categories. First are precious metals like gold, silver, platinum, used for jewelry, investment, and even industrial applications. Then there are energy products, oil, natural gas, coal. Without these, factories shut down, cars stop moving, and electricity grids fail. Third ones are industrial metals, copper, aluminum, nickel, key materials for everything from construction to electronics. And the fourth category is agricultural products, corn, wheat, coffee, cotton. Without these, you don't eat, wear clothes, or get your morning caffeine fix. Now, here's where things get interesting. Who actually buys commodities? First, there are producers and processors. Farmers, mining companies, and manufacturers trade directly in the spot market because they deal with the actual physical goods. Then there are traders and investment managers. These guys prefer futures and forward contracts because they don't have warehouses to store barrels of oil or sacks of coffee beans. They're in it for price speculation, hedging, or portfolio diversification. Let's say an airline company is worried about rising fuel costs. If oil prices shoot up, their costs go through the roof. To avoid this, they lock in oil prices using futures contracts. This way, they pay a fixed price no matter what happens in the market. That's hedging in action. Another key point, some commodities are easier to trade than others. Precious metals like gold are a breeze because they don't spoil and have a high value to weight ratio. But something like corn, that needs to be stored properly, has quality variations, and can perish, making it trickier to trade. Now, let's move on to real assets, the physical stuff you can see and touch. These include real estate, airplanes, machinery, farmland, and even infrastructure like highways and bridges. Now, you may be wondering what distinguishes real assets, and the answer is they're unique. No two buildings, airplanes, or pieces of land are exactly alike. They're illiquid. Unlike stocks, you can't sell half of an office building overnight. They're hard to value. Their worth depends on location, condition, and future earning potential. Let's say a company buys a fleet of airplanes. The value of those planes depends on their condition, demand for air travel, fuel efficiency, and even airline bankruptcies. If airlines start struggling, those planes lose value fast, but if demand for travel booms, they become highly valuable assets. Now guys, let's see, how do you invest in real assets? There are two ways. First one is through direct investment. This means buying a rental property, farmland, or even a fleet of trucks. The upside, full control and direct income generation, rent, leasing fees. The downside, high costs and management headaches. Another one is indirect investment. Instead of buying a building, you can invest in real estate investment trusts, REITs, or master limited partnerships, MLPs. These are companies that own real estate or infrastructure and sell shares to investors. The best part? They trade on stock exchanges, so they're liquid and easy to buy and sell. Let's say you want exposure to real estate but don't want to deal with tenants, maintenance, or property taxes. Instead, you buy shares of a REIT that owns hundreds of commercial buildings across different cities. You get a share of the rental income, but you don't have to fix leaky pipes at 3 a.m. Why should investors care about these asset classes? Currencies impact global businesses. If the dollar strengthens, U.S. companies that export goods struggle to compete globally. If the yen weakens, Japanese exporters like Toyota get a boost. Commodities are inflation hedges. If inflation rises, commodity prices usually go up, protecting purchasing power. Real assets generate steady income and diversification. Rental properties, infrastructure, and farmland provide income and don't move in sync with stocks and bonds, making them a great diversification tool. So whether you're investing directly or indirectly, understanding currencies, commodities, and real assets is essential for building a well-balanced portfolio. And for the CFA exam, you'll definitely see questions on these topics, so make sure you've got them locked down. All right, let's break down the basics of contracts in finance. These are essentially agreements to buy, sell, or swap stuff like securities, currencies, or commodities in the future. Let's go through the key types of contracts and what they're about in a practical, everyday sense. Contracts can be physical or financial. Physical contracts involve real, tangible stuff. Think oil, lumber, or gold. If you're trading actual barrels of oil or stacks of lumber in the future, that's a physical contract. Financial contracts are based on financial products, not physical goods. For example, options or contracts involving stock indices or interest rates fall here. A derivative contract is a fancy way of saying that the contract's value depends on something else, like a stock price or an interest rate. Let's say you have a contract whose value changes with Apple stock. This is an equity derivative. If it changes with a debt security, it's a fixed income derivative. These contracts can be settled in two ways: physical settlement, where you actually deliver the goods, and cash settlement, where instead of physical delivery, you just settle up with cash. And then there are spot contracts. These are immediate real-time trades within about 3 days that happen on the spot market. A forward contract is basically an agreement to trade an asset in the future at a specific price. They're custom-made deals often used by companies to hedge against potential risks, like fluctuating prices. However, forwards have some risks and drawbacks. The most prominent one is counterparty risk, because you're relying on the other side to fulfill their end of the deal. And no oversight means more risk. Since these contracts aren't standardized, it can be tough to find someone willing to take over if you want out early. Futures are similar to forwards, but with key differences. They're standardized, regulated, and traded on exchanges. Each trade is backed by a clearinghouse, which reduces risk by requiring traders to post an initial margin, a financial buffer. If the initial margin dips below a required level, traders get a margin call to top it up or risk having their position closed out by their broker. Let's say you bought 10 futures contracts with an initial margin of $80,000. If prices drop and your margin falls below the required amount, you'll get a margin call to cover the difference. A swap contract is an agreement to exchange cash flows at specific times. Swaps are useful for managing risks tied to interest rates, currencies, and even stock prices. Here's how they work in different cases. Interest rate swap involves trading fixed interest payments for variable ones, or vice versa, depending on the needs of each party. Think of commodity swaps like a safety net for businesses dealing with unpredictable commodity prices. Instead of gambling on whether oil, gold, or wheat prices will soar or crash, companies lock in fixed payments, swapping uncertainty for stability. Take an airline, for example. They can use a commodity swap to secure fuel prices, shielding themselves from sudden spikes and keeping costs predictable. It's all about smart risk management. Currency swap. Here, payments are exchanged in different currencies, which is particularly useful for companies doing business across international borders. Equity swap involves exchanging fixed payments for returns tied to a stock or stock index. An option contract gives you the right, but not the obligation, to buy or sell something at a set price by a certain date. There are two main types. Call option gives the right to buy an asset. You'd exercise this if the market price is higher than the agreed price. Put option gives the right to sell an asset. You'd use this if the market price is lower than the agreed price. Options come with a premium, a fee you pay up front, and they come in two styles. European style options can only be exercised at maturity, whereas American style options can be exercised anytime up to maturity. Unlike forwards and futures, options give you a choice, not an obligation. But keep in mind, option writers, sellers, are on the hook if the buyer decides to exercise the option. All right, now let's talk about some other fascinating risk management tools: insurance contracts and credit default swaps, CDS. These are like the financial world's version of a safety net, catching you if things go south. Take a CDS, for example. Think of it as credit risk insurance. Imagine you're a bank that lent money to a company, but you're getting a little nervous. What if they default? Well, you can buy a CDS from another party, pay them periodic premiums, and in return, they promise to compensate you if that company fails to pay its debt. Pretty neat, right? In essence, CDS contracts work like an insurance policy for lenders, providing a cushion against the risk of default. It's all about transferring risk to someone else who's willing to take it on, at a price, of course. Financial intermediaries, or FIs, act as the bridge between buyers and sellers, ensuring that trades and investments flow seamlessly. These intermediaries range from banks, whether commercial, mortgage, or investment, to credit institutions like credit unions and credit card companies. Brokers, exchanges, dealers, clearinghouses, mutual funds, hedge funds, and insurance companies all play distinct roles in this ecosystem. Brokers, for instance, serve as agents who facilitate transactions on behalf of clients without directly trading with them. Their primary mission is to find the best possible prices for their clients' orders, either by matching clients themselves or through sophisticated computer systems that identify potential trades. For this service, brokers earn commissions. They may work independently or within larger brokerage firms, the brokerage arms of banks or exchanges. Large orders, often referred to as block trades, require special handling, as substantial buy or sell orders often trade at premiums or discounts to the market due to their size. When brokers extend credit to clients wishing to buy on margin, they transition into the role of a financial intermediary, lending funds sourced from other clients' deposits. Some brokers specialize in serving institutional clients, such as hedge funds. These are known as prime brokers and are essential in providing financing and other specialized services. Investment banks also serve a critical role, offering advisory services to corporate clients for transactions like initial public offerings, IPOs, or seasoned security offerings. They also assist with mergers and acquisitions, guiding companies as they navigate complex business combinations. Securities exchanges provide a centralized marketplace where buyers and sellers meet to conduct trades. These exchanges, like the Tokyo Stock Exchange, also have a regulatory function, ensuring issuers disclose financial information accurately and refrain from creating capital structures that grant excessive voting rights to a select few. Exchanges are typically overseen by national or regional governments, with further regulation provided by organizations like the U.S. Securities and Exchange Commission, SEC. Alternative Trading Systems, ATS, or Electronic Communications Networks, ECNs, offer another trading venue. ATS platforms owned by broker-dealers, exchanges, or specialized companies resemble exchanges in function but do not regulate subscribers beyond trading conduct. Some ATS platforms even run innovative systems, suggesting trades to clients based on customer information or proprietary research. Dark pools, a subset of ATS, do not display orders from customers, offering anonymity and often catering to large institutional managers. Unlike brokers, dealers transact directly with their clients. When a client wants to sell, the dealer buys from them. When they want to buy, the dealer sells from their own account. Dealers profit from the difference between buying and selling prices and may operate through traditional human decision-making or automated trading systems. By providing liquidity, dealers allow clients to enter and exit positions with ease, particularly in over-the-counter and exchange markets. Some dealers, known as primary dealers, play a unique role by conducting transactions with central banks to adjust the money supply through the buying or selling of government securities. Arbitrageurs bring yet another dynamic to the financial landscape, seeking opportunities to profit from price discrepancies across markets. By purchasing a security in one market at a lower price and selling it in another market at a higher price, arbitrageurs help balance supply and demand. In markets that are highly efficient, these opportunities are rarer, but arbitrageurs continue to add liquidity and promote price alignment. For example, arbitrageurs connect buyers and sellers arriving at the same time in different markets, while dealers do so within the same market at different times, making offsetting trades as opportunities arise. Each of these financial intermediaries, brokers, dealers, exchanges, and arbitrageurs plays a distinct yet interconnected role, ensuring that the financial ecosystem remains vibrant, efficient, and accessible. Securitization enables companies or securitizers to pool assets and convert them into securities that investors can buy. A typical example involves mortgage banks, which create residential mortgages by lending to homeowners. These mortgages are gathered into a pool, and shares of the pool, known as mortgage pass-through or mortgage-backed securities, are then sold to investors. A mortgage bank acting as a securitizer is a financial intermediary with the mortgages as its assets and the mortgage-backed securities as its liabilities. Pass-through securities are particularly appealing to investors as they diversify the risk of mortgage defaults and early repayments. This approach makes pass-through securities both easier to value and more liquid than individual mortgages, contributing to higher market prices. Importantly, higher mortgage prices mean lower interest rates, benefiting homeowners as well. Special purpose vehicles, SPVs, or special purpose entities, SPEs, are often created to facilitate securitization. These entities ensure that assets and liabilities tied to securitized securities remain off the securitizer's balance sheet. Asset-backed securities, such as those backed by car loans, credit card receivables, and bank loans, also follow this model. In asset-backed securitization, different classes or tranches of securities emerge. Senior tranches are first in line to receive cash flows from the asset pool, thus lower in risk. Junior tranches hold residual rights to the pool's cash flows and carry higher risk, earning the nickname toxic waste due to this increased exposure. Exchange-traded funds, ETFs, representing ownership in the assets held by the fund, are another example of asset-backed securities and are highly liquid due to low transaction costs. Depository institutions such as commercial banks, savings banks, loan banks, and credit unions play a crucial role as financial intermediaries. They gather deposits from individuals and businesses and extend loans to borrowers. These institutions bridge funds from depositors and investors to borrowers, acting as conduits within the financial system. Other financial corporations, like acceptance corporations, discount corporations, and payday advance providers, serve borrowers by securing loans with various assets, such as consumer items, machinery, or future paychecks. Their loans are financed through commercial paper, bonds, and share sales. A notable aspect of depository institutions and financial corporations is their priority structure. Depositors and lenders have primary claims over equity owners, shareholders, who only claim residual profits. Thus, the ability of these institutions to cover credit losses relies on the capital invested by shareholders, impacting the terms on which they can access funds. Insurance companies serve as intermediaries between policyholders who buy insurance to protect against potential losses and the investors, creditors, and reinsurers who assume these risks. Insurance policies cover a range of risks, from auto and fire to life, liability, and disaster. When a loss event occurs, The insurance policy provides payment to the insured. The owners and creditors of insurance companies are indirect bearers of the risks the company assumes. Insurance companies can further mitigate risk by purchasing reinsurance policies, while thereby transferring some of their risk to reinsurers. Typically, insurance firms maintain a broad portfolio of diversified policies, reducing overall risk relative to individual contracts. Insurance premiums hinge on anticipated loss rates and operational costs. To control adverse conditions, insurance companies tackle issues like fraud, moral hazards. Fraud in insurance occurs when losses are either falsely reported or intentionally caused by individuals looking to receive payouts, creating financial strain on insurers. Moral hazard is another risk factor where the very presence of insurance can make people act with less caution, leading to a greater likelihood of incidents or losses. Additionally, adverse selection refers to the tendency of higher risk individuals to purchase insurance more often than others, resulting in a pool with disproportionately high losses that can challenge the insurer's ability to cover claims effectively. All right, let's shift our focus to an area that's crucial yet often overlooked: settlement and custodial services in the financial system. Think of settlement services as the financial world's version of closing a deal. When you buy or sell securities, it's not just a handshake and a promise. The transaction needs to be finalized, and ownership must be officially transferred. This is where clearinghouses come into play. Clearinghouses act as intermediaries between buyers and sellers, ensuring that trades are settled correctly and efficiently. They reduce the risk that one party might default on their obligations, which is essential for maintaining trust in the markets. Imagine if you sold your car but the buyer never paid you. That's a risk the clearinghouse mitigates in financial transactions. Now let's talk about custodians. Custodial services are like the safekeepers of the financial world. Custodians hold securities on behalf of investors, ensuring their assets are secure and accurately accounted for. It's similar to having a safety deposit box at a bank. You know your valuables are protected. In the financial markets, custodians prevent issues like theft, loss, or even simple clerical errors that could result in significant financial loss. These services might not be as flashy as trading stocks or analyzing financial statements, but without them, the financial system would be far less stable and efficient. They provide the plumbing that keeps the financial house in order. Now that we've laid the groundwork on financial markets, let's move into something that every investor, trader, and analyst needs to understand: positions. Whether you're buying stocks, trading futures, or hedging risks, knowing the difference between long and short positions is key to making smart investment decisions. So, what's a position? A position is just a way of saying how much of an asset or contract you own or owe. Every investor holds either a long position when they own something or a short position when they've sold something they don't actually own. Let's start with the more familiar one, going long. When an investor takes a long position, they're buying an asset with the expectation that its price will rise. This is the most common type of investing because it's straightforward. You buy low, sell high, and pocket the profit. If you buy shares of Apple today, you're taking a long position in Apple stock, hoping that as the company grows, its share price will climb, and you'll make money. Companies issuing bonds also create long positions for investors. When an investor buys a bond, they're essentially lending money and expect to earn interest while getting their principal back at maturity. The best part? With a long position, your losses are capped at what you invested. If the stock or bond goes to zero, you lose what you put in, but no more than that. Now, let's flip the script. Short positions work in the exact opposite way. When an investor takes a short position, they're betting that an asset's price will fall. Instead of buying first and selling later, short sellers sell first and buy later. hoping to buy it back at a lower price. Here's how it works. You borrow shares from someone who owns them, usually through a broker. Then you sell those shares in the market at today's price. And if the price drops, you buy them back at a lower price, return them to the lender, and keep the difference as profit. But here's the thing, short sellers don't get off easy. Because they borrow the asset, they have to pay interest or dividends back to the lender. These payments are called payments in lieu of dividends, and they can impact your overall return. Now, this is where things get really interesting. While most investors make money when prices rise, short sellers make money when prices drop. Instead of buying first and selling later, short sellers sell first and buy later, hoping the price will go down so they can buy it back at a lower price and pocket the difference. Let's say you think Tesla stock is overhyped and bound to fall. Instead of buying shares, you can borrow Tesla stock from your broker, sell it at today's price, and plan to buy it back later when it drops. If Tesla's stock price falls, you buy it back at the lower price, return the borrowed shares, and keep the profit. Sounds great, right? But here's the catch. If Tesla's stock price skyrockets instead of falling, you're in big trouble. Unlike a long position where your losses are capped, a short position has unlimited risk because a stock's price can technically rise forever. That's exactly what happened during the GameStop short squeeze of 20 to 21. Hedge funds shorted the stock expecting it to drop, but retail traders pushed the price up, forcing short sellers to buy back at much higher prices, leading to billions in losses. Short selling also comes with additional costs that long investors don't face. Since short sellers borrow assets, they have to pay dividends or interest back to the lender. This is known as payments in lieu of dividends. Plus, short sellers have to put up collateral, the proceeds from selling the borrowed stock, while the lender invests that collateral in short-term securities. The lender then rebates some of the interest earned back to the short seller at a rate called the short rebate rate. If the stock is easy to borrow, the rebate rate is close to market interest rates. But if the stock is in high demand and hard to borrow, like what GameStop case, as I said earlier, rebate rate can drop to near zero or even negative, making short selling extremely expensive. All right, folks, let's keep this rolling and explore some key derivative positions. Long and short positions aren't just for stocks. They apply across different financial instruments. Understanding long and short positions also helps when dealing with futures, options, and other derivatives. In a futures contract, the long position benefits when the underlying asset's price increases, while the short position gains when it decreases. Options work a little differently. The buyer of an option, whether a call or put, has the long position, while the seller or writer has the short position. In swaps, the long side benefits when the quoted price increases, while the short side benefits when it falls. And in currency forward contracts, a long position in one currency automatically means a short position in another. If you take a long forward position in euros, you're also short the US dollar in that trade. So, guys, why this matters in the real world? Any clue? Long and short positions aren't just for hedge funds and traders. They play a critical role in risk management. Airlines, for example, take short positions in oil futures to hedge against rising fuel prices. If oil prices spike, their short position offsets the increased fuel costs, keeping their expenses stable. In investment portfolios, short selling can act as a hedge against downturns. Portfolio managers often short stocks or indices to protect their long positions, reducing overall risk. Think of a futures contract like a bet between two traders. One trader believes the price of an asset will go up. This is the long side. The other trader believes the price will go down. This is the short side. The long side benefits when the asset's price increases, while the short side profits when the price falls. It's like buying concert tickets in advance. If demand increases and prices skyrocket, you make money selling them later at a higher price, just like a trader holding a long futures position. But if you think prices will drop, you sell now and buy later at a cheaper price, just like a short futures trader. Options work a bit differently because they involve a buyer, also called option holder, and a seller known as writer. The option holder, or buyer, always holds the long position, while the option writer, or seller, always holds the short position. The key here is understanding risk exposure. For a call option, the long position benefits when the underlying asset's price rises. If you buy a call option, you're hoping for a price increase, like purchasing land expecting its value to appreciate. On the flip side, if you sell or write a call option, you want the price to stay the same or decrease because you make money off the option premium without having to pay out gains. For a put option, the long position benefits when the price of the underlying asset falls. If you buy a put option, you're betting on a price drop, much like shorting a stock. Meanwhile, the short position in a put option benefits when the price stays the same or rises, since the seller collects the premium and avoids having to buy the asset at a loss. Now let's move to swaps and currency forwards, which are often used by businesses and institutional investors to manage financial risks. In a swap contract, the side that benefits from an increase in the quoted price is called the long side, while the side that benefits from a decrease in price is the short side. For currency forward contracts, a long position in one currency is essentially the same as a short position in the other. Imagine you're exchanging US dollars for euros. If you go long on euros, you're simultaneously short on dollars because you're giving up one currency to hold another. Whether you're dealing with futures, options, swaps, or currency forwards, understanding whether you're long or short is essential. Always ask yourself, am I profiting if the price rises long? Or am I making money if the price falls short? Mastering these concepts will not only help you in your CFA exam, but also in real-world trading and risk management. Let me say that again. You're going to see this concept show up in your CFA Level 1 exam questions, so make sure you understand it thoroughly. Long positions benefit when prices rise, and the most you can lose is what you invested. Short positions benefit when prices fall, but losses can be unlimited if prices spike. Short selling requires borrowing, paying interest dividends, and managing the cost of borrowing rebate rates. Hedging with long and short positions helps companies and investors manage risk, whether it's airlines hedging fuel prices or portfolio managers protecting against downturns. Before we move on, let me draw your attention to something super useful: the battle-ready PDF summaries you see on your screen. These are downloadable and printable, meaning you can keep them handy for quick revision anytime, anywhere. Whether you're cramming before an exam, need a refresher before a practice test, or just want a structured breakdown of key concepts, these summaries are designed to save you time and help you retain the most critical information. Think of them as your cheat sheet for success: concise, to the point, and packed with exactly what you need to master derivatives. So make sure you grab your copy and use it to reinforce what we're covering in this lecture. Next up, let's talk about leverage positions, how traders use borrowed money to amplify their investments. Now, leverage can be an incredible tool when used wisely, but it can also wipe out your capital faster than you can blink if things go the wrong way. This is why understanding how margin trading works, how leverage multiplies returns, both good and bad, and how margin calls can force you to act is critical for anyone looking to trade with borrowed funds. Let's say you have $10,000 and you're excited about a stock that you believe is about to surge. Instead of buying $10,000 worth of shares, your broker allows you to borrow an additional $10,000 to double your buying power. Now you can control $20,000 worth of stock with just $10,000 of your own money. This is called buying on margin. The amount borrowed is called the margin loan, and the stock itself is used as collateral. This means your broker is lending you money, but they expect you to pay interest on that loan, just like a bank would. The interest rate you pay is called the call money rate, and it's typically higher than the government bond rate. Large institutional traders often get better rates than retail investors, just like big corporations can secure lower borrowing costs than small businesses. Leverage allows you to control a larger position with less money, but it also magnifies both profits and losses. The leverage ratio tells us how much larger your total position is compared to your actual investment. For example, if your broker requires you to put up 40% of the total purchase price as your own money, the leverage ratio is total position divided by your equity. In this case, that would be 100% divided by 40%, which equals 2.5. That means you're controlling $2.50 of stock for every dollar of your own money invested. Now, let's say the stock price rises by 10%. Without leverage, your return would simply be 10%, but because you're using a leverage ratio of 2.5, your actual return on equity is 10% times 2.5, or 25%. Sounds great, right? But what if the stock drops by 10% instead? That same leverage effect works against you. Your loss isn't just 10%, it's 10% times 2.5, which means you lose 25% of your investment. This is where leverage becomes dangerous because losses can pile up much faster than most traders expect. Leverage is great when things are going well, but brokers don't let you ride out unlimited losses. They have something called a maintenance margin requirement, which is the minimum amount of equity you must maintain in your account. If your equity falls below this level, your broker issues a margin call, which means you must deposit more cash or risk having your position liquidated. Let's break this down with an example. Imagine you bought a stock at $20 per share using 40% margin, which means you put up $8 per share of your own money and the rest was borrowed. If the broker's maintenance margin is 25%, your broker will issue a margin call if your equity falls below that level. To calculate the price at which a margin call happens, you take your initial equity per share and adjust for price changes. In this case, the critical price would be $16 per share. If the stock price drops below that, your broker will demand that you deposit more funds, or they will automatically sell your shares to recover their loan. This is why margin calls are so dangerous. If you don't have extra cash to deposit, your broker may force you to sell at a loss, turning temporary paper losses into real, permanent ones. Let's look at a scenario. Suppose you buy 1,000 shares of a stock at $20 per share using 40% margin. This means you invest $8,000 of your own money. You borrow $12,000 from your broker. Your total investment is $20,000 worth of stock. Now imagine that over the course of a year, the stock price falls to $15 per share. Here's what happens. You now sell your 1,000 shares for $15,000, a $5,000 trading loss. You still owe your broker $12,000. You also owe 5% interest on the margin loan, which equals $600. You received $100 in dividends, but that's not enough to offset the losses. After deducting trading commissions, your final equity balance is just $2,490. That means your initial $8,000 investment has been cut down by nearly 69%, even though the stock itself only dropped 25%. That's the power and the risk of leverage. If you thought buying on margin was risky, short selling adds even more complexity. When short sellers borrow shares and sell them, they must maintain a margin balance in case the stock price rises instead of falls. If a stock jumps higher and the short seller's equity drops below the maintenance margin, they're forced to deposit more money or close the short position at a loss. This is exactly what happened in the GameStop short squeeze. As the stock skyrocketed, short sellers had to buy back shares at massive losses, fueling the price rally even further. Now let's explore a more advanced approach, portfolio margining. For traders and institutions managing multiple assets, brokers often use portfolio margining, which is a system that assesses risk across the entire portfolio rather than just individual positions. Instead of setting fixed margin requirements, brokers use risk models to determine the overall risk of the client's portfolio, which can result in lower margin requirements for diversified portfolios or higher requirements for highly concentrated high-risk positions. Leverage is a powerful tool, but it's also incredibly risky. It allows traders to control large positions with limited capital, but it also magnifies both gains and losses. Understanding how leverage ratios work, how margin calls are triggered, and how brokers manage risk is essential for both CFA candidates and real-world investors. So folks, leverage increases both upside and downside risk. A 10% move in the stock can result in a 25% return or a 25% loss if using 2.5 leverage. Margin calls force traders to deposit more funds or have their positions liquidated, often at the worst possible time. Short sellers also face margin requirements, meaning they must maintain enough equity to cover rising stock prices. Portfolio margining helps brokers assess risk across an entire portfolio rather than just individual trades. Now let's talk orders and execution instructions, basically how trades actually happen in the real world. You'll see this in the exam, but more importantly, it's what separates a well-informed investor from someone just pressing buttons and hoping for the best. I know this module is a lot to take in, kind of like trying to function without coffee on a Monday morning. But stick with me because it's a game changer for your CFA Level 1 equity section. So, orders and execution instructions, one of the most important aspects of trading. Whether you're buying stocks, trading Forex, or managing a hedge fund's portfolio, understanding how to place the right type of order can impact your execution price, transaction costs, and even your overall profitability. Think of it like this. If you walk into a store to buy something, you don't just throw your money on the counter and hope for the best. You check the price, decide whether you're willing to pay it, and if it's too high, you might wait for a sale or make a counter offer. Trading works the same way. You can either buy at the current market price, or you can set conditions to control when and how your trade gets executed. Whenever you place an order, it's not just a matter of saying, I want to buy 100 shares of XYZ. Instead, you have to consider how you want that trade executed, who will handle the settlement, and even how visible your order is to the rest of the market. All of these factors can affect your profits, your costs, and how quickly you can buy or sell. When placing an order, you generally need to specify the security you're trading, the quantity, and whether you're buying or selling. However, you also need to lay out some trading terms. These terms can cover details like whether you want the trade to happen immediately at the current market price or whether you're willing to wait until the price hits a certain level. For instance, if you're convinced that a particular tech stock is undervalued and you want to buy it, you might simply say, buy me 1,000 shares at whatever price the market is offering. On the other hand, if you're more cautious, you might say, I only want to buy if the price is below $200 per share. These kinds of specifics are crucial in making sure you get the outcome you're aiming for. Execution instructions tell your broker or the exchange exactly how to fill your order. This includes how long you want the order to stay valid, whether you care about partial fills, and the level of price certainty you need. If you're in a rush and absolutely want your order filled right now, you might place a market order. Beyond execution, traders also need to think about clearing instructions, which determine how a trade is settled. For retail investors, this is usually handled automatically by their broker, but for institutional trades, the responsibility may lie with a custodian or another broker. If a trader is selling a stock, they also need to specify whether it's a long sale, meaning they own the stock, or a short sale, meaning they have borrowed the stock and must eventually buy it back. Brokers must ensure that short sellers have access to borrowed shares before allowing the trade, as failing to do so could cause settlement issues. Clearing instructions come into play once the trade has been executed. They specify how the final settlement will be arranged and which party is responsible for making sure shares or bonds or whatever else move from seller to buyer and cash moves from buyer to seller. In the case of a retail investor, the customer's broker usually takes care of all this behind the scenes. Institutional traders, however, might rely on a custodian or a specialized clearing broker to settle everything. Exposure instructions determine how your order is displayed or shared with the market. Some traders prefer total transparency, posting their entire order for everyone to see. Others might want to keep part or all of their order hidden, especially if they're dealing in large quantities that could move the market. Every market has two fundamental prices, the bid and the ask. The bid is what buyers are willing to pay, and the ask or offer is what sellers are willing to accept. The difference between these two is the spread, and a tight spread usually indicates a liquid market where it's cheaper to trade. If you imagine walking into a car dealership, the sticker price on the car is the ask, and the highest offer from buyers is the bid. If you absolutely need that car right now, you'll have to pay the sticker price. If you can wait, you might negotiate or see if the price comes down. In the financial markets, market makers often post both a bid and an ask, making it a two-sided market. If you're making the market, you're setting these prices. If you're taking the market, you're accepting them. Traders who take the market are the ones who cross the spread by buying at the ask or selling at the bid. You'll often hear about liquidity providers and liquidity takers. Liquidity providers post limit orders, effectively providing the rest of the market with a standing offer to buy or sell. Liquidity takers come in and execute trades against these existing offers. A practical example might be a trader who sees a great limit order offering a good price and decides to trade right away. That trader is taking the market, and the limit order poster is making the market. When it comes to actual order types, the simplest one is the market order. This is the get it done now approach, which guarantees you'll be filled, but you don't know exactly what price you'll get if the market moves fast. So folks, when you place an order, you need to decide how it should be executed. If you want your trade filled immediately, you use a market order. Here you are willing to buy at the best available price or sell at the best available bid. The advantage is that execution is guaranteed, but the downside is you don't control the price, especially in volatile or thinly traded markets where your order might get filled at a much higher or lower price than expected. To avoid this uncertainty, traders often use limit orders, which allow them to set a specific price at which they are willing to buy or sell. A limit buy order ensures that you don't pay more than your desired price, while a limit sell order guarantees that you don't sell for less than your target price. The trade-off here is that while you control the execution price, there's no guarantee that your order will be filled. If the market moves away from your limit price, your trade may never happen. To understand this better, imagine a scenario for market order. Suppose you're looking to buy a rare watch at an auction. If you place a bid for $10,000 and someone else bids higher, you won't get the watch unless you raise your bid. But if the highest bid remains below $10,000, you secure the watch at your preferred price. A limit order works exactly the same way. You set the price, but execution depends on market conditions. Sometimes you'll hear about aggressively priced limit orders which are so high for a buy or so low for a sell that they'll almost certainly execute immediately. These orders behave much like market orders in practice because you're effectively crossing the spread. So folks, traders who want their limit orders to execute faster can set aggressively priced limit orders. If you place a limit buy order above the current best bid, you increase your chances of execution, but you may end up paying a slightly higher price. Similarly, if you set a limit sell order below the best offer, your order is more likely to be filled, but you may receive a lower price than if you had waited. Another common strategy is the marketable limit order, which is designed to execute immediately because it is placed at or beyond the best offer price. If you set a buy limit order at or above the best ask, it functions similarly to a market order getting filled right away. Why? Because their prices are in line with, or even better than, the best bid or ask. A buy order placed below the current best bid is behind the market. It will only fill if the market price drops to your level. Think of it like fishing. You cast your line lower than where the fish currently are, hoping they'll swim down to your hook. Placing a sell limit between the best bid and the best offer creates a new best ask or offer. You're offering a slightly better deal to potential buyers, but you won't trade instantly unless someone is eager to buy at your price. Standing limit orders are limit orders that sit patiently in the market, waiting for a matching trade. If someone comes along willing to meet your price, the trade executes. All or nothing AON orders are a special case where you only want to trade if you can trade the full size you requested. This can be important for certain institutional strategies where you don't want to end up with half a position. If even one share can't be matched, the order just sits there unfilled. Some traders prefer hidden, also called iceberg orders, where only a portion of the order is visible to the market while the rest remains hidden. This is often used by large institutional investors who don't want to move the market by revealing the full size of their trade. Imagine a hedge fund trying to buy 1 million shares of a company. It wouldn't want to show that order all at once because it might drive up the stock price. Instead, it places an iceberg order, showing only a fraction of its intended purchase at a time. So, folks, market orders guarantee execution, but can lead to unpredictable prices. Limit orders give you control over price, but come with execution risk. Traders can use aggressively priced limit orders, marketable limit orders, or hidden orders depending on their strategy. Institutional investors use advanced execution techniques to avoid moving the market, while corporations carefully structure their buybacks to minimize impact. Understanding these different order types and instructions is crucial because the wrong execution strategy can cost traders money. If a trader needs to buy 10,000 shares of a stock and places a market order, they might push the price up as their order gets filled at increasingly higher prices. On the other hand, if they place a limit order that's too low, they might miss out on the trade altogether. This is why professional traders carefully consider both market conditions and execution costs when placing trades. In high-frequency trading, for example, firms use advanced algorithms to execute thousands of orders per second, constantly adjusting prices and strategies to maximize profits. These firms rely on sophisticated order routing techniques to find the best possible execution across multiple exchanges. Even corporations take order execution seriously. When Apple buys back its own stock, it doesn't just go into the market and place a massive market order. Instead, it carefully spreads out its purchases using limit orders and algorithmic trading strategies to avoid pushing the stock price too high. Now, let's talk about limit price placement, where you set your buy or sell order relative to the market price and how that affects whether your trade happens instantly or just sits there collecting dust. If you're placing a buy order above the best offer price, congratulations, you're marketable, meaning your order is so attractive that it'll likely get snapped up right away. But if you try to sell above the best offer, you're now behind the market, meaning no one's biting unless prices rise to meet you. If you place your buy order exactly at the best offer, it's still marketable, meaning it should execute quickly. And if you sell at the best offer, you're considered at the market, meaning your price is in line with what buyers are willing to pay. So you're likely getting filled. Now, if you get a little fancy and place your order somewhere between the best bid and best offer, you're in the market. This means your order isn't the most attractive deal out there, but it's also not totally out of the game. If prices shift in your favor, you might get filled. Here's where things get interesting. If you place a buy order at the best bid, you're now at the market, meaning you're offering the highest price buyers are willing to pay. So your order stands a good chance of being executed. Meanwhile, if you try to sell at the best bid, your order becomes marketable. Since you're meeting the highest price buyers are currently offering, you'll probably get filled fast. But let's say you place a buy order below the best bid. Now you're behind the market, meaning you're offering too low and will likely be ignored unless prices drop. On the flip side, if you sell below the best bid, you're actually marketable because you're giving buyers a great deal. And that means your order will likely be filled in no time. Bottom line, if you want your order to execute quickly, you need to place it where the action is. If you are not aggressive with your price, you'll have to sit and wait, maybe forever. But if you're too generous, you might leave money on the table. The trick is knowing when to be patient and when to jump in. Next up, validity instructions and clearing instructions. All right, imagine you're at a coffee shop. You walk up to the barista and say, I want a cappuccino, but only if you can make it within the next 5 minutes. Otherwise, forget it. That's essentially how some market orders work, time sensitive and conditional. Let's break down these different types of validity instructions in a way that makes sense. A day order is like saying, I'll take that coffee if you can make it today. If not, cancel my order. It's the most common type of order. If it doesn't get filled by the time the market closes, it disappears. Poof, no more order. A good till canceled GTC order, on the other hand, is like telling the barista, keep my order open until I come back and tell you otherwise. It remains active until it's filled or manually canceled, even if that takes days or weeks. IOC, immediate or cancel, / fill or kill orders. Now, imagine you're super impatient. You tell the barista, I need this coffee right now or forget it. That's an IOC order. If it can't be filled immediately, it gets canceled on the spot. No waiting around. A fill or kill FOK order is even stricter. It's like saying, I need a full tray of 6 cappuccinos right now or I'm out. Either you get everything instantly or the order is completely canceled. No partial fills. Ever met someone who only drinks coffee in the morning or right before bed? That's what market on open, MOO, and market on close, MOC, orders are like. A market on close order means you're only willing to buy or sell at the closing price of the day. Mutual funds love these because they value their portfolios at the closing price. A market on open order does the same thing, but at the opening price. It's for traders who want to get in at the first bell, hoping for momentum plays. All right, let's talk about stop orders, your financial seatbelt. They're designed to protect you from big losses, just like you'd buckle up before hitting the road. First, stop by order. Picture this. You think Tesla stock is overpriced at $250, so you short sell it, hoping to buy it back cheaper later. But what if you're wrong and it starts climbing? You don't want to bleed money forever. A stop buy order at $260 acts like an emergency brake. If Tesla's price hits $260, your order turns into a market buy order to stop further losses. Now, flip the script. You bought Apple stock at $180, thinking it'll go up. But what if it tanks? A stop sell order at $170 makes sure you don't lose more than you can handle. If the stock drops to $170, the order triggers and sells your shares to limit damage. Here's the tricky part. Stop orders don't guarantee an exact price. If Apple suddenly crashes past 170 to 165, your stop sell order will still trigger, but you'll get filled at 165. Ouch. That's why some traders use stop limit orders instead, which say, sell my Apple stock at $170, but not below $168. It adds protection, but the risk is if the price never recovers, you're stuck holding the bag. Next, let's explore where it all begins in the world of investing, the primary security markets. If you've ever wondered how companies raise money or how stocks even get to the public, this is the lesson for you. This is where companies go from private to public, where investment banks step in and where those early investors either cash out big or not. What is the primary market? Think of the primary market as the first stop for newly issued securities. This is where companies sell their shares or bonds directly to investors, raising capital for expansion, acquisitions, or even just paying off debt. Once those shares are out in the world, they move to the secondary market, where investors trade among themselves. There are two main ways companies issue securities in the primary market: initial public offerings, IPOs, and seasoned offerings. Initial public offering, the IPO. An IPO is like a startup going from a garage project to the big stage. The founders and early investors want to cash in, so they sell shares to the public. An initial public offering is when a company sells its stock to the public for the first time. It's a huge moment, the transition from a private business to a publicly traded company. IPOs allow early investors, founders, and employees to cash out, while new investors get a chance to buy into the company's future. Let's take a real-world example. Think of Facebook's IPO in 2012. Before its IPO, Facebook was privately owned by Mark Zuckerberg, venture capitalists, and early employees. But when Facebook went public, it sold shares to regular investors for the first time, raising $16 billion in one of the biggest IPOs in history. The cash raised helped fund its expansion, acquisitions, and global growth. You know, some investors thought the stock was overpriced at $38. It dropped on the first trading day, proving that IPOs don't always guarantee instant profits. So, not all IPOs are a guaranteed success. If an IPO is priced too high, demand might be weak, leaving the underwriter stuck with unsold shares. If it's priced too low, the stock might skyrocket on the first trading day, great for early investors, but a sign that the company left money on the table. Investment banks play a huge role in setting that price and ensuring the offering goes smoothly. Once a company is already public, it might need more money. That's where seasoned offerings, also called secondary offerings, come in. These are when a company sells additional shares after its IPO. A perfect example, Tesla. It has done multiple secondary offerings to raise money for expansion, new factories, and product development. Since Tesla's stock price kept rising, it could sell more shares at higher prices, raising billions without taking on debt. How investment banks make it happen? Companies don't handle IPOs or secondary offerings on their own. Investment banks do the heavy lifting. These banks help structure the deal, set the share price, and market the stock to investors. There are different ways they do this. First is accelerated book building. When companies need money fast, investment banks arrange the offering in 1 or 2 days and sell shares at a discount. Then is best efforts offering. The bank acts more like a broker, trying to sell as many shares as possible, but not guaranteeing all will be sold. Another one is underwritten offering, the most common method. The investment bank guarantees the sale of all shares at a set price. If investors don't buy them, the bank does. This is risky for banks, so they charge a fee, usually around 7% of the amount raised. But investment banks have a conflict of interest here. As the company's agent, they should set the price high enough to raise the most money. But as an underwriter, they also want the stock to be priced low enough to attract buyers and ensure a smooth launch. So what happens when a company or bank gets the price wrong? If the IPO price is set too high, demand will be weak. The bank is forced to buy shares itself, and the stock might trade lower on its first day. This is called an undersubscribed IPO, and it makes it harder for the company to raise money in the future. If the IPO price is too low, the stock will be oversubscribed, demand will be overwhelming, and the price will skyrocket on the first day. This sounds great, but it means the company could have raised more money had it set a higher price. For example, in LinkedIn's 2011 IPO, the stock doubled in price on the first trading day. That was great for early investors, but it meant LinkedIn left millions on the table that could have been raised at a higher offering price. Not all companies want to go public through a traditional IPO. There are alternative ways to sell shares depending on what works best for the company. Private placements. Here, instead of selling shares to the public, companies can sell them to wealthy investors or institutions like pension funds and hedge funds. These deals require less regulation and are often cheaper than public offerings. Then is shelf registration. A company registers shares but doesn't sell them all at once. Instead, it releases them slowly over time when it needs cash. This helps avoid a sudden flood of shares that might drive the price down. Next is dividend reinvestment plans. Here, companies let shareholders reinvest dividends into more company stock, often at a slight discount. This helps the company raise capital without issuing new shares to the public. Rights offerings. Existing shareholders get the first opportunity to buy new shares before the general public, usually at a discounted price. This ensures they maintain their ownership percentage. Governments often raise funds by selling securities through public auctions, where investors bid for bonds, notes, or bills. Larger, financially stable governments like the US or Germany can sell their securities directly to the market without relying on investment banks, while smaller or riskier governments may need intermediaries to help place their debt. Once these securities are issued, they move to the secondary market, where investors trade them among themselves. Why secondary markets matter for IPOs? A company's stock price in the secondary market affects how much it can raise in the primary market. If investors know they can easily trade a stock after buying it, they'll be more willing to invest in an IPO. That's why companies want liquid active secondary markets. It makes raising capital cheaper and easier. A great example is Amazon. In its early years, it didn't generate much profit, but because its stock was liquid and in demand, it could easily raise billions through secondary offerings, fueling its massive expansion into cloud computing, streaming, and e-commerce. Now let's explore secondary security markets and contract market structures. Whether you're investing in stocks, bonds, or derivatives, knowing how markets are structured will help you navigate trading like a pro and understand how securities get priced, matched, and executed. Markets don't all work the same way. Some operate on a strict schedule, while others allow trading around the clock. This brings us to the two main types of trading sessions. First, we have call markets. Imagine an old school auction where buyers and sellers gather in a room at specific times to trade. In call markets, trades only happen at pre-scheduled times. The market is called once or several times a day, and all the buy and sell orders for a particular security are processed together. This structure is ideal for less actively traded securities like corporate bonds because it concentrates liquidity into a specific moment, making it easier for buyers and sellers to find each other. However, between these trading sessions, the market is totally illiquid, meaning you can't trade until the next session. Call markets use single price auctions to match buyers and sellers. Here's how it works. Traders place buy and sell orders before the market call. The market selects one single price that allows the highest volume of trades to take place. This price is determined by where the demand from buyers and the supply from sellers intersect. A good analogy is concert tickets for a high demand event. The event organizer might set a single price that clears all demand, meaning everyone who is willing to pay that price gets a ticket, while those who bid too low miss out. Now, let's talk about continuous trading markets. Unlike call markets, continuous trading markets allow trades to happen anytime during market hours. Think of the New York Stock Exchange or NASDAQ. Traders don't wait for a specific moment to buy or sell. They execute orders throughout the day as new information flows into the market. Continuous markets are more volatile than call markets because prices react instantly to breaking news. But this also means prices adjust much faster, which is why these markets dominate stock trading. Interestingly, some exchanges combine both structures. For example, many stock exchanges use a call auction to determine opening and closing prices, ensuring a fair and efficient market open where supply and demand are matched in bulk. Once a trade is placed, it needs to be executed, and there are three main types of market structures that determine how that happens. The first type is quote-driven markets, also known as dealer markets or OTC markets. In a quote-driven market, customers trade directly with dealers, who provide price quotes and facilitate transactions. This is how the NASDAQ operates. Dealers stand ready to buy and sell securities at publicly posted prices. A great comparison would be a foreign exchange kiosk at an airport. The kiosk posts an exchange rate. Let's say $1 US is equal to 0.85 euros. And if you accept it, the transaction happens immediately. You're not negotiating with another traveler, you're trading with the dealer. This system works well for highly liquid securities like major stocks or Forex, where market makers ensure that there's always a price available. The second type is order-driven markets or auction markets. Order-driven markets work differently because buyers and sellers trade directly with each other rather than through a dealer. The New York Stock Exchange is an example of an order-driven market where traders place orders that get matched based on specific rules. Here's how an order-driven market works. Traders submit buy and sell orders to the exchange, and these orders are ranked based on price. The highest buy order and the lowest sell order get matched first. If there's a match, a trade happens. If not, orders wait in the system until someone is willing to accept the price. A perfect real-world example is an online marketplace like eBay. If you're selling a rare baseball card, you might list it for $100, but if the highest bid is $90, no trade happens unless you agree to lower your price. The transaction only occurs when a buyer and seller meet at the same price. This type of market reduces the need for middlemen like dealers and allows the market to self-regulate based on supply and demand. Next one is order matching and trade pricing rules. Since order-driven markets rely on matching buyers and sellers, there are rules in place to determine whose order gets filled first. First comes the price priority rule. Orders offering the best price get executed first. If two buy orders are placed, the one offering the highest price will take priority. If multiple orders have the same price, then time priority kicks in. The order that arrived first gets executed first. Now let's talk about how trades get priced. There are three main pricing rules. The uniform pricing rule is most common in call markets. It sets one price for all trades, the price that allows the most trades to happen. Think of this as setting a single ticket price for a concert to ensure maximum attendance. The discriminatory pricing rule is used in continuous markets. Here, the price is determined by the limit order that arrived first. If a trader places a buy order for $50 per share, but the stock is offered at $48, the trade happens at $48, which is better for the buyer. The derivative pricing rule is used by crossing networks, platforms where trade prices are determined by reference to another market. These networks often match large institutional trades without affecting the public market price. Sometimes buyers and sellers can't easily find each other, especially in markets with large, complex, or illiquid assets. This is where brokered markets come in. In a brokered market, instead of buyers and sellers trading directly, a broker acts as an intermediary to connect them. This system is commonly used for real estate, private equity, large blocks of stocks, and even fine art. Imagine you're a billionaire trying to buy a rare Picasso painting. You don't just walk into a store and pick one off the shelf. Instead, you hire an art broker who reaches out to potential sellers, negotiates prices, and arranges the sale. This is exactly how brokered markets work for large institutional trades in stocks, bonds, and other complex financial instruments. Transparency is a big deal in financial markets. Some markets provide real-time data on quotes and orders, called pre-trade transparency, while others only reveal trade details after transactions are completed. This is called post-trade transparency. Market transparency is a big deal, especially for buy-side traders, the ones managing investments for mutual funds, pension funds, and hedge funds. When markets are transparent, they can see real-time prices, understand liquidity, and accurately estimate trading costs, making it easier to execute trades efficiently. But not all markets operate this way. Opaque markets, where pricing and order flow details aren't fully visible, tend to benefit dealers, allowing them to profit from information asymmetry. The result? Wider bid-ask spreads and higher transaction costs, meaning buy-side traders end up paying more just to get their trades done. That's why investors prefer transparency. It levels the playing field and reduces costs. So folks, buy-side traders prefer transparent markets because they can see real-time supply and demand, making it easier to trade at fair prices. Dealers, on the other hand, prefer opaque markets where they have an information advantage and can profit from wider bid-ask spreads. The best example is the foreign exchange market, a largely opaque market where big banks have an edge because they can see order flows that smaller traders can't. Now, why this matters for CFA candidates and real-world traders? Well, understanding market structures is key to executing trades efficiently and minimizing costs. Call markets concentrate liquidity but trade only at specific times, while continuous markets allow real-time trading but can be more volatile. Execution mechanisms like quote-driven, order-driven, and brokered markets determine how orders are matched, and different pricing rules impact who gets the best deal. Now let's finalize the topic by exploring last two concepts that shape how financial markets function: well-functioning financial systems and market regulation. Whether you're an investor, a trader, or someone managing risk, these two areas determine how efficiently capital flows, how information gets reflected in prices, and how market participants are protected from fraud and manipulation. Let's break it all down so you can see how these principles actually apply in financial markets. What makes a financial system well-functioning? Think of a financial system like the nervous system of an economy. If it functions smoothly, money flows where it's needed, investments generate fair returns, and businesses can easily raise capital. But if the system is broken or inefficient, money gets stuck, risks aren't managed well, and economic growth slows down. A well-functioning financial system has three key characteristics. First, it has complete markets. A market is considered complete when traders have access to all the financial assets and contracts they need. This means that whether you're an investor looking to buy stocks, a company issuing bonds, or a farmer hedging against price fluctuations, there's a financial instrument available for you. Take commodity markets, for example. Farmers who grow wheat don't just rely on current prices, they use futures contracts to lock in a price for their crops before they're harvested. This allows them to manage risk and plan ahead. Without these futures contracts, wheat prices would be far more volatile and farmers would struggle to stay in business. Similarly, when an entrepreneur wants to raise money, they need access to equity markets, stocks, or debt markets, bonds. If these markets didn't exist, companies would have to rely solely on bank loans, limiting growth and innovation. Second, it is operationally efficient. A financial system is operationally efficient when trading is fast, easy, and cheap. In other words, transaction costs like broker fees, bid-ask spreads, and execution delays are kept to a minimum. Imagine two stock exchanges. Exchange A has high fees, slow trade execution, and a wide bid-ask spread. Exchange B has low fees, instant execution, and a narrow bid-ask spread. Where would you rather trade? Obviously Exchange B, because you get the best price and your trade is completed quickly. A highly liquid market is another sign of operational efficiency. In markets like the New York Stock Exchange or NASDAQ, investors can buy and sell shares with minimal price impact because there are so many participants. Compare that to trading a small cap stock in an emerging market, where selling a few hundred shares might push the price down dramatically due to low liquidity. When a market is operationally efficient, it encourages more trading, which leads to better price discovery and improved market stability. The final piece of the puzzle is informational efficiency, meaning that all available information about an asset is reflected in its price as quickly and accurately as possible. Take Tesla stock, for example. When CEO Elon Musk announces a new innovation, the stock price reacts instantly. That's because thousands of traders, algorithms, and institutional investors are processing the news in real time. But imagine if markets weren't informationally efficient. If big investors had access to information before the general public, they could buy or sell stocks ahead of time, making unfair profits. This is why timely financial disclosures, such as earnings reports, economic data releases, and regulatory filings, are crucial for maintaining a fair marketplace. In a poorly functioning financial system, insider trading runs rampant, and price manipulation is common. This leads to capital being misallocated, risks not being shared properly, and economic inefficiencies. Why does market regulation matter? Well, folks, without proper regulation, financial markets can become a Wild West, where fraud, insider trading, and unfair practices dominate. The role of regulators is to keep markets fair, transparent, and efficient, ensuring that investors and businesses operate in a stable environment. Imagine playing a soccer match where some players are allowed to use their hands, move the goalposts, or change the score whenever they want. That's what an unregulated financial market would look like. Big players taking advantage, unfair deals, and investors constantly at risk of fraud. That's why regulators step in to keep the game fair, protect investors, and ensure the market runs smoothly. Regulators have one main goal: to promote fair and orderly markets that are both operationally efficient, meaning smooth transactions, low costs, and informationally efficient, where everyone has access to fair, timely information. To make that happen, they set up systems to protect investors from fraud and hold financial professionals to high standards. So brokers, investment managers, and financial advisors actually know what they're doing. One of the biggest issues regulators try to fix is agency problems, where financial professionals put their own interests ahead of their clients. Imagine a stockbroker recommending a high-fee mutual fund just because it gives them a bigger commission, rather than choosing the best option for their client. Regulators enforce minimum competency standards and ethical guidelines to prevent this kind of thing. Another major focus: insider trading. If company executives or hedge fund managers use private information to trade stocks before the public knows about it, they extract profits at the expense of everyday investors. Regulators crack down on this because it hurts market liquidity and damages trust in the financial system. If people believe the markets are rigged, they stop investing. Regulation also ensures that financial companies don't take reckless risks that could lead to massive collapses. That's why banks, insurance companies, and pension funds must maintain minimum capital levels and reserves so they have enough money to cover losses and meet their financial obligations. If banks overextend themselves and fail, like Lehman Brothers did in 2008, the entire financial system can be thrown into crisis. Now, not all regulation comes from the government. There are also self-regulating organizations, SROs, groups like stock exchanges and clearinghouses that set and enforce their own rules for their members. Think of SROs like industry watchdogs. They work under government oversight but have the power to regulate trading practices, enforce ethical behavior, and maintain market integrity. In the US, for example, organizations like the New York Stock Exchange, NYSE, and FINRA operate under the supervision of the SEC, Securities and Exchange Commission. At the end of the day, a well-regulated economy runs more efficiently, attracts more investors, and leads to greater wealth creation. Strong regulations mean fairer markets, lower risks, and more confidence in the financial system, which benefits everyone, from individual investors to massive institutions. Without it? Well, history has shown us what happens when markets are left unchecked: financial crises, scandals, and economic meltdowns. So, folks, while market regulation is essential for maintaining fair, transparent, and stable markets, regulators, on the other hand, prevent fraud, conflicts of interest, and insider trading, while also ensuring that financial institutions don't take on excessive risk. If financial markets weren't properly regulated, investors would lose confidence, leading to lower market participation, higher costs, and weaker economic growth. For your CFA exam and your future career, understanding how financial systems function and why regulation exists will help you analyze market behavior, identify risks, and make better investment decisions. To reinforce these concepts, be sure to download the PDF on your screen, which includes key takeaways, a perfect final review for your CFA exam studies. And remember, FinQuiz has you covered with other valuable products too, like Stanley Notes, formula sheets, mock exams, and a top-tier question bank to sharpen your skills. All right, that's a wrap for this lecture on market organization and structure. We covered a lot, so take some time to review and, most importantly, practice. Go through the end of chapter questions from the CFA Institute books. That's where the real learning happens. Stay consistent, stay curious, and I'll see you in the next lecture. Until then, happy studying.